23 of the Fireplace podcast. This week we're interviewing Richard, who has reached financial independence and is a regular at our meetups. We're talking to him about his fire journey and what he gets up to now. Before we start, we should mention our regular disclaimer. We're amateur investors and this content is intended to be us learning together rather than any regulated financial advice. We urge you to check anything you hear here with any other sources, and just to repeat, we're all amateurs, so don't take anything we say too seriously. We've also got Andy on the show. Hello, Andy.
I thought you were going to say, and speaking of amateurs, here's Andy.
And Richard, just give us a quick introduction of what you're up to and how you bumped into us.
Excellent. Hi, Mike. Hi, Andy. Thank you for inviting me on. So in terms of quick introduction to me, I fired age 47, which was 9 years ago now. And in terms of introduction to fire, I wasn't actually aware of fire until the last 100 days before I fired. So it was something where I became aware of the movement after I'd already got to that point.
Right. And what sort of background did you have in terms of your family's attitude to money and your first jobs?
In terms of family, I'm quite extreme and unique in terms of my approach to money within the family. So I'm seen as the kind of the outlier there. My dad was very bad with money. In fact, he was a gambler. So he's very much someone who doesn't necessarily recognise investments or pensions. My mum was much more prudent, or is prudent, but nowhere near to the extremes that I am.
So, Richard, did you just immediately start out realising you needed to invest when you were earning and had spare money, presumably?
So as a young person, so 13, I was out there with babysitting jobs and paper rounds and just earning money. Without any real reason for why I was doing it. I was taking the money, I was taking it to a savings account and watching it build, but and these are obviously relatively small sums, but there was nothing in there in terms of investing per se. But then I was very early into things like I was always looking to find out ways to make more money, and so things like newspapers, and I got the hang of looking at shares and understanding what price earnings and yields were. That would have been before I was 16 that I was looking at that sort of stuff. Very interested in business and went on at A levels to do business and statistics, which are both very kind of significant because the statistics fits in very well with the probability and the gambling side of it, because I've always had an interest in gambling as well, and also on the investment side of it.
And with those in mind, what sort of career did you head towards?
I was actually very clear about what I wanted to achieve. So when I was at school, and I went to a state school, very non-ordinary in terms of the way it was. So the expectations of what you could achieve were low. But when I was asked at careers what I wanted to do, I said I wanted to run a chain of sports shops. So I was seen as a slight outlier at school as well in terms of what I was aspiring to achieve. And so I was the one who didn't get the work experience as a bricklayer or on the Corona van at the time. They weren't able to find me something that would suit. But I was kind of working at that time anyway through jobs in shops and stuff. So it wasn't really a problem from a work experience perspective.
Right. And then presumably over time, your career kind of moved more into business yourself, did it?
Yeah, so career-wise, I left school at 18, so I was keen to get out and earn money. I didn't apply for university, so I was 100% set on going and getting a job. And I joined Debenhams on their A-level training scheme. So in a way, my career aspirations versus what I did were very attuned even at age 18. However, I worked for a year, hated it. I did quite well during that year, but even so, I felt things weren't moving quick enough for me. And so at that time, I'd fortunately gotten good enough grades at A levels to go to university. So my mum was very keen that I said, if I didn't want to carry on working, why don't I go to university to see what it's like? So I did go off to university almost by accident with no preconceived ideas of what I'd do there, but absolutely loved that time. And having spent that year of working at Debenhams, The biggest lesson I got there was I had absolutely nothing to show for it, really. So I went to university with a car. I bought the things that young people would buy in terms of stereo equipment and stuff while I was there. But my car very quickly became unaffordable. So midway through university, I had absolutely nothing to show for the fact I'd spent a year working, and I'd hated that year of working. So it was from there that I got that mindset, which is if I'm going to go out to work, I'm going to actually find a way of not having to work, which was my primary ambition when I left university.
Right. So you kind of started out with the idea of working as a means of earning enough money to not work.
That was it, and that came to me quite quickly. So I was probably in my within my first 12 months of having left university, where I was leaving with that mentality, and actually thinking about it even before then, because I was, from the day I started working on a graduate training scheme, I was saving from that point on. So I'd already moved into long-term savings right from the point of leaving university.
So I guess that compared to a lot of people we talk to, the concept of FIRE or early retirement sort of hit you very early on. So you kind of were already quite clearly on that path from quite a young age.
Yeah, I think it's probably one of terminology, because I'm retrospectively taking terms that I'm aware of now and almost applying it to how I was at 19. But in reality, at the time when I was 19, it was a case of I knew that I could accumulate money, and the money could compound, which would save me from having to work. That's what I was trying to achieve. The retiring early per se wasn't really a thing. I had no concept of why I was doing it. I just wanted to stop working as quickly as I could.
Yeah, one of my questions to people on the podcast often is how much the concept of early retirement and financial independence is just an extension of sort of financial common sense. So people generally are told, you should always earn a bit more than you spend, you should always put a bit by for a rainy day and that kind of thing. And I guess you were doing that already, but probably more so than most people of your age and most of your peers.
Yeah, very much so. So bear in mind that when I got my graduate job, that was more than I'd ever been paid in my life at that time. So it was very easy to save because it was money I'd never had before. And then because my career went quite well, I was forever getting promoted and getting pay rises. I was in procurement, which at the time would come with a car. So every job I got that was an improvement on the previous job, but I'd also get a better car. And so for me, I was seeing my income improving and my savings going up, but at no point did I ever have to make a sacrifice to say, actually, I'm going to give up something to achieve something else. It just wasn't noticeable.
So how did this progress from saving into investing? What were your first investments, and how did you start your snowball rolling?
Okay, so my first bit was to pay off debt. Now, so I left with university debt, but at the time it was very early introductions into. I was in Scotland, so we had the poll tax trialled on us students in Scotland, and then it was also the start of graduate loans. But at that stage, they were so low compared to now that I left with something like £1,500 worth of debt, which tells you that apart from the loan, I was kind of managing my expenses while I was at university. And so I basically, from working, the first thing I did was paid off that loan, which would have been a matter of months from leaving university. And then I just started saving, and I saved into it was a Tesla, I think they were called, so it's a forerunner to ISAs. And I distinctly remembering the point at which I'd got £1,000 in my account, and thought, this is amazing. I'm walking down the street and thinking everyone must realise that I'm solvent and everything's amazing, because that to me was like quite a major milestone. But there was not a lot of thought to it. I would have just looked and gone, where was the lowest cost Tesla or the highest returning one in theory at that time, and started putting money there. Probably the most significant thing I did at that stage was I went and bought a flat in Luton, which is where I grew up. So I bought a flat to live in, and I would have been 23, 24 when I did that. So I was very early into the world of property. So at that time, I'd saved enough money to go and get a mortgage on a place.
And while you were doing this, presumably you were quite enjoying work.
No, so the first job I had, I absolutely hated. So I went in as a graduate trainee at Tyrac, um, and it was very similar to now actually. So at the point that I graduated, jobs were hard to come by, but I'd got the benefit of having worked for a year in retail, which meant that compared to most graduates who were leaving, I'd got a business degree, I'd got a year of actual experience. I was well placed to find a job, but I was going into a store environment, which was exactly where I didn't want to be.
But by the same token, though, having the Tessa and reaching a sort of target of savings and paying off your loans, you were in a much better position to be able to change jobs maybe than some of your peers who might have been kind of more.
Um, I guess I think for me it was really one where my period of being unhappy in my job lasted probably 2-3 years after university. And again, and this is probably common to most graduates, particularly if you do business, you're taught how to do business strategy, and then you come out and you're said, well, it's great that you know how to do business strategy. Could you fill the shelves up? And you're doing stuff that you feel you could do more of, and so you don't feel like you've been used to your full capabilities. So it wasn't until a couple of years on where my career progressed. So my first job that I absolutely loved was I went to Martin Retail Group, and I was buying music for them. And at that stage, when I became a buyer, was the point that I went, I absolutely love this. I like my job, and it's the first time where I actually was able to align working with enjoyment. And ironically, I was getting paid a lot better at that stage. So all the time that I'm not enjoying work, I'm being paid badly for stuff I don't like doing. And then when you do like work, you've been paid really well for stuff that's more enjoyable. So that was like an eye opener to me. And the higher up you go in the chain and the easier the jobs get, the more you get paid. So it's a brilliant
And
story.
you're working in an environment which is not a million miles away from investing. If you're procurement and you're buying things for a business, it gives you presumably some knowledge of how business operates. And did that help you to choose your own investments?
I think the link there is that the thing that makes me who I am is that I'm a commercial person. I do like numbers. I do like money, and I'm in a world where I'm as a buyer, you're trying to generate gross profits and reduce cost prices for businesses. So the two skills are very entwined. And then when it comes to investments, I very much see investments as investments in businesses or collections of businesses. So if you take the difference between me and a normal index investor, an index investor's probably come into investments and not really sure where to go and has been pointed in the direction of, well, why don't you buy a global index? It's a safe way to go. They will conceptually know the 7,000 businesses in that index, but to what extent is the knowledge there about, well, how does an individual business create and generate money, and what are the different metrics by which you value a business? And yes, there's profit, but there's also the how do you actually make the business itself grow in value, which is sometimes and sometimes not related to profits. And that's stuff that I inherently understood right from an early stage. And having spent many, many years at it, I've obviously got better and better level of understanding of how businesses work and how they're valued. And that very much informs my investing.
And while you were doing share investing, you were also investing in property at the same time. Is that right?
Yes, but there's a lot of years in between that statement. So I was along my corporate career, my money was going into my pension, and I was an aggressive AVC investor in pensions, mainly to avoid the 40% tax threshold. So I never ever paid 40% tax while working, so which gives you a level of how extreme my investment was from day one. And because I don't necessarily trust myself from an investment point of view, everything was going into the company pension. And then I was using any excess money, I would be using that to buy shares and do all the bad decisions where I'd made the wrong investments and had some, that would have been my paid education, if you want, in terms of investing in single stocks. And the property side of it was very much a case of I was buying property to live in. So the first house that I mentioned that I bought when I first left university, I rented that for a period. I didn't need it anymore, and I sold the property, and I think I made £1,000. So it was really it was a non investment. And the next property I bought, I was age 30, and it was one that I bought with my wife to be. and that was very much buying a family house because we had a daughter on the way. So it wasn't until much later, towards the end of my corporate career, that I ended up investing in property from an investment perspective.
Right. So you had quite early on, you ring fenced a chunk of money to go in the company pension that was kind of safe and you weren't going to fiddle with, but you kept your play money separate for trying things out.
Very, very much so, and that was a really good discipline. So I'd say the pension itself wasn't the greatest investment vehicle, but the making sure that you don't touch it was a very, very good thing to do. I should also mention actually that when I first left university, I went to see a financial advisor. So at the point that I got my mortgage, I also went to speak to a financial advisor, and I learned an awful lot from that. I had that advisor for about a year, and I learned an awful lot from that financial advisor. So for me, given that yes, they were taking a high percentage of my my savings or investments, but at that stage my investments were negligible, so I paid practically nothing for that advice. And then the moment that I'd acquired the knowledge, I was then in a very, very good position to then go off and use that knowledge thereafter. So for me, that was a great investment. Obviously, that predates internet, so I suspect you could get that advice if you just Googled it or Chat GPT it and get similar quality. But for me, I've never been against a financial advisor if the financial advisor sets you up on the right path. And for people who really don't want to know much about money and just want to be kept with that discipline about just don't touch it, even if it's not the world's greatest investment, as long as it goes up and it's doing quite well, then don't touch it. Then there's a value to that.
So you mentioned investing in single stocks and getting burnt. Was that part of a pattern of you were doing well with some and others were a disaster, or what shape did all this take?
So it was really, it shaped my learning. So initially, my first stock was actually House of Fraser, and I had to go to a bank to buy it. And I think I spent £70 in charges to buy a £1,000 of shares in House of Fraser. And I bought some of the public issues, so Railtrack and British Energy at the time. So they predominantly went quite well. I then moved into, at the time I was able to get a tele-trading account, which was HSBC's. You could phone up and buy shares, and that was much cheaper, still something like £30 a share, but it was less than 60 and more convenient. And I was buying single stocks, but I got into .com stocks a time that was bad to get into .com stocks. So my first big financial education was in the .com crash, where I got wiped out of an awful lot of stuff I'd got, and some of that was silly, imprudent investing, and some of it was, on the face of it, you'd gone, that was really sensible. So I'd invested in Vodafone and Marconi, which at the time were two of the top 10 companies in the UK. I would suggest there's a read across there to Meg 7, and felt that I was in a safe stock that would always survive quite well, and of course it didn't.
And what was your strategy here? Obviously, you're trying to buy into growth stocks at the right time, but were you planning to long-term buy and hold, or were you planning to exit those stocks at a certain point and then move on to different ones?
It was just pure opportunism. So I was just trying to find ways to make money. And I like the idea that you buy something, do nothing, and you get more out the other end of it for clicking a few buttons or making a phone call. There wasn't really any rationale. And I was looking for stocks which I felt had high growth potential. But why I came to those versus others, I couldn't rationalize it.
This does remind me that we're always kicking ourselves saying, I wish we'd learnt this earlier and got into this sooner. But actually, looking back with your story, getting into it early, there was a massive friction to the frictional costs of investing. And it wasn't easy, was it? You're describing going into the branches of financial institutions to buy shares and telephone services being an advance on that.
Yeah, so it was hard to trade in terms of compared to now. The cost of trading was like way more expensive as a cost per transaction, and then the knowledge behind what you're doing. So I'm working off newspapers and gossip or talk and feelings, and very limited knowledge. So although I was very interested in business, it's very notable that my only real understanding of business was walking into shops. That's how I got into retail, because if you're into business as a young person, retail is a very visible form of how business works. And so that's my route in. It wasn't until much later on and moving in through private equity that I got a much better understanding of different businesses and how they actually work and make money.
So moving forward over time, as you said, you ended up working in private equity, and you'd already then by that point built up a significant pension pot, presumably through the employer scheme, and also your private investments had done quite well, and you'd done a bit of property, and then you found yourself working presumably for bigger companies as a consultant.
Yeah, so it was actually smaller. So again, the property journey hadn't massively happened at this stage. So at the point I left corporate, which I was age 39, I had an investment in a house that I'd bought. Again, I'd bought that house for personal reasons rather than for an investment. It just happens that that house was big enough to put another house in the garden. And so at the point that I was leaving, I got planning permission to have another dwelling in that garden, and I was able to sell that plot off for something like 130 grand, and it didn't affect the value of the house. In fact, I sold the house for a margin more than I'd paid for that in the end. So it was only at the point that I was moving from corporate to private equity work that I made any money, real money on property. And it was only really after I fired that I started to take that money and invest it aggressively in property. So all the way up until my fire point, that was very much done on the basis of money invested in my corporate pension, plus moving into, I ended up having a personal pension as well as the corporate one, because as I moved in through my first consultancy jobs, they didn't come with pensions, so I'd set my own one up. So the point that I hit my fire button, which would have been the first time I met you, that was all based on the fact that I had an amount of money that I'd managed to effectively save through absolutely pure pension and equity growth.
And presumably you'd been tracking this over time, so you knew that once the numbers got to a certain level, that was the point at which you didn't need to work anymore.
Yeah, so I had a number in mind that I wanted to hit, and then a very painful thing here, I was on a contract, and I knew, because I knew what my day rate was, I was able to have a 100-day tracking to FI, so I knew exactly what day I was going to hit FI. And they were the most painful 100 days of my career. I wish I'd never done it. You're much better off just living each month and finding you've got there, because it just makes each day really, really painful, because that time goes very, very slowly when you're just trying to hit a number.
But by the same token, you were less inclined to suffer from one more year syndrome and then do another year just to be on the safe side.
Yes, because I knew my number, and I was shooting that, and I'd spent my whole life trying to get to this point.
Yeah.
So this was what I wanted. I never had would I like to retire a year later? That was never ever a consideration.
So it sounds like you've played the pension game very effectively there, but did that leave you in a situation where you were over the line, but you were a bit light on the bridging fund?
Yeah, in terrible situation. So a couple of my probably my worst mistake I've made in hindsight was not putting sufficient money into ISAs or understanding the true value of ISAs. So at the time, I just thought, well, I could save 40% here. What could be better? It never occurred to me the idea that actually your accumulated wealth could save you tax in the future. And so I didn't play ISAs. And in fact, every time I saw a financial opportunity, I was quite happy to take money out of the ISA to invest it in something else.
One thing that we bump into quite a lot is that people say the same thing, but usually what they say is they didn't realize how quickly their pension pot would advance, and they get to, say, their late 40s or early 50s, and then realize that their pension pot is now big enough to theoretically support their lifestyle, but then they realize that they weren't expecting to retire that early, so they hadn't bothered putting enough in the ISA to cover the gap. With you, it sounds like you kind of had it all in mind, but then when you got there, you realized that the ISA wasn't big enough.
Yeah, I mean, I wasn't completely so it wasn't quite that stupid, but a bit that stupid. So bear in mind that when I was on this journey, the pension access age was 50, and then it got moved from 50 to 55. Now, for most people, they weren't shooting for 50. They're more concerned that their pension age had moved up from 65 to 66.
Yeah.
For me, when you're like within a sniff of 50 and it moving up, that to me was a really painful move. Second only to when they moved AA films to 15 when I was age 14. The rules changed while I was there. And so I knew that I had to be able to bridge to pension access, but that was something I kind of worked out on the hoof. So I know we'll talk about debt at some stage, but I've used a lot of debt to bridge.
Right. So yeah, so you're now at sort of 49 and you realise that you've hit your target and you've got some investments and some money and you've got the pension there, but not accessible for another 5 or 6 years. So what sort of things did you get right? What did you get wrong on that journey?
So in terms of I mentioned that I absolutely should have invested in ISAs early on because that would have made the whole thing a lot easier. The bit I did well was I worked out that through compounding, you get a lot of people who are trying to chase the lifetime allowance number within pension. I know that doesn't exist today, but for simple terms, people are trying to get £1 million in their pension because that's seen as the most tax efficient way of doing it. I'd worked out that if I could get to a quarter of that every 10 years, that should double and it can compound its way there without me having to do anything. So I did lay off pension contributions really early on, which was sensible. So I raced to get to a quarter, but then just stopped, which then meant I was starting to develop access to. So I was using ISAs then. So I was accumulating ISA wealth, but not just to the extent that I needed it. And then I also mentioned that I'd got the property where I'd sold the land off as well. So I'd got some cash from that. And then I also had the fact that when I left corporate, I spent a long time teeing that, so I was paid to leave. So that was and I left as a good leaver. So I ended up getting both redundancy and stock options and a few other things on the back of leaving corporate. So I had a few sources of cash. Where I went wrong was when I left corporate. This is before I did private equity. I set up a chain of jewelry shops that managed to set them all up and shut them all within 6 months. So that was a corporate thing that didn't work out. So that wasn't a great use of cash. That's it really.
Right, interesting. And then quite a big question. Did you have an idea of what you wanted to do once you'd hit that number and stopped working?
Not massively. Now, I said I didn't come to fire until I'd fired. During the 100 days that I was running down, I actually was working in Edinburgh and I was flying up there quite regularly. And it was at that stage that I discovered a podcast, which was The Mad Scientists. So that was the literal point at which I discovered that there was a fire movement and became aware of Mr. Money, Mustache, etc. So I knew doing that I needed to give some thought to what I was going to do when I stopped working and get round the idea of purpose, and that a lot of people stop and don't really know what they're doing it for, and etc. So I could have been very guilty of that, but I had a good 100 days thinking about that in some depth.
However, that's not very long though.
No, but it's long enough not to be shocked and to have a feeling of of making sure you're retiring to something rather than just retiring for the sake of it. But what you can't do, I think, in the world of working is actually think of it correctly, because you're not confronted with this amount of time that you get when you retire during your working life. So no matter how much you might think about it and go, I'll live on a beach or I'll do some fishing and I'll make my day's work through by doing my hobbies, the amount of time you have is much more than you're used to having. And I think it's conceptually quite difficult to understand how that works when you're working.
And I guess that because you were in a succession of roles, you didn't have the opportunity, well, it didn't sound like you had the opportunity for any kind of mini retirements or a kind of sabbatical or a sort of trial break before you hit the big number because you were too keen to just get there.
Well, I absolutely could have done, because I was working project to project. I could easily have stopped and had mini retirements. It's just I wasn't aware of the concept of mini retirement until my last 100 days, in which case I had a full retirement. So I knew it was a reversible decision. So I didn't burn any bridges on the way out. So there was that element of it. And I had things that I wanted to do. So I wanted, my daughter was on her way at that stage. So I knew that I was able to go and have a family life. Was a big part, and spend a lot of time seeing my daughter from very early on, and spending all the time I would have liked to have spent with my other two elder children. So I knew that was there. I knew I was going to invest in property and set up what I saw at the time was going to be a lifestyle property business. I thought I'd learn a language and a musical instrument and all the classic middle-aged things you think you might do. So I had a kind of aim of what I was going to do. So it wasn't a complete shock. But as I went through those activities, you learn about what you like and what you don't like, and what you miss from work, and what you and so you start to be able to shape your retirement around those sorts of aspects.
Yeah, I think from the sounds of it, compared to a lot of people we've talked to on the podcast and people in the Facebook group who mention it, you had a pretty good plan for what you're going to do, even if you built it up, in the last few months, and that you sort of not exactly hit the ground running, but you had at least an idea of what retirement would look like, so it wasn't too much of a shock. I always talk to people about the sort of decompression factor when you kind of suddenly all the pressure's off. And I think that can sometimes, along with, as you say, having all this free time, can sometimes give people a bit of vertigo or a bit of kind of, I don't know, a sort of lack of identity or something. But it doesn't sound like you've suffered too badly.
I mean, I would say I probably did suffer. It was just that it's a bit while ago, and I've worked through a lot of that. So the shocks of the system is you've suddenly got a lot of time that you didn't have before. The thing that I obviously worked very hard and would long hours during the week, and it was all about, and the job would be all consuming. So I would think about it the whole time. To go from that to having nothing you need to think about is a very different mindset. And then there's things about the job that I loved that you just don't get in a normal life. So I'm not saying it's extreme as this, but you imagine a world where sports people retire and they're used to the adulation, etc., of that, and have to go and then create a new life. They have a very extreme element of what goes on. I think retirement's like a very small version of what a sports person would go through as they go from one life to another.
So now in retirement, I'm getting an impression you are treating the investing as one of your purposes, and aside from the hobbies, you spend time on your investing. I know you're both property investing and you're doing investing in shares and companies. So does that take up a lot of your time between the two?
So investment probably an hour a day in terms. So the first thing I do is I take my daughter to school, and then I sit down for an hour and just look at how things are going and look at reports. Try not to look too much about individual share prices moving. I'm more interested in economic themes, what's going on in the world, and reading company reports around stuff that I invest or similar to what I've invested in. So I'll do that. The property is a case of probably only takes a day, maybe 2 days a month normally. But if I'm buying or doing a refurb, then during that refurb period, it will take a day a week to during that. So you get kind of periods where I bought a property middle of May, and so I was working more intensely on that between middle of May and when I got it let by the end of June. But outside of that, then once it's settled down again, it just becomes part of the portfolio, and it's very low time.
And I think you mentioned also that you were going to get involved in some mentoring and some charity work as well.
Yes, right. I didn't mention that. So from the moment that I left, I became a trustee of 2 homeless charities, very local ones, and then also there's the Kent Foundation. So it's about mentoring young entrepreneurs. It's not paid, and that actually worked very well because that was a way of kind of living vicariously through somebody else. So that has really suited me, and that stuck. The homeless charities didn't stick, although I am going back to join a much larger one in the next few weeks. So I learned a lot from that working on a local charity, but it's such that it's not something I'd want to do long term unless it's a really big charity.
I find it really interesting when you describe the investing as being about reading company reports and such. That chimes with me. It's very reminiscent of Warren Buffett, Berkshire Hathaway, and their capital allocators. And you listen to, I mean, one of the guys on their books is Ted Weschler, and he says he describes his day, his working day, as reading. As does Buffett, and they say it's all about just soaking up enough of the picture so that you know what's going on. That you said economic themes, macroeconomic, and it's understanding what's going on with businesses, isn't it? Because you're buying businesses and you're minimizing your risk by improving your knowledge.
Very much so, and this knowledge has accumulated over. This isn't something where I've retired and started to read these reports. I've been doing this since I was 25 onwards. So House of Fraser, I read their company report when I first bought a share there. So I've been doing this sort of activity my whole working life, and the little bits of knowledge just add on and add on and add on, and you start to smell stuff that's going on that you sometimes you can't even put numbers to it, but you can just see stuff going on, or you might learn something in one area that's completely seems non-relevant to another sector, but you can see how it will apply. So a good example would be you saw the growth of weight loss drugs coming up, but there was a bit of a lag before the markets got the hang of actually weight loss drugs were going to have an impact on food and alcohol. So there's a theory that a lot of Diageo's poor performance, for example, has been caused by the fact the literal appetite for alcohol has gone down globally than it had before. And you start to smell that. You see things like growth of cannabis consumption in the US as it becomes legalized, and you see this direct correlation between cannabis consumption and reduction in alcohol. And so you can see some of these themes come through before you see them play out in company accounts. So every now and then you spot something, you go, actually, that's just uncanny, and I can smell something happening there.
Do you employ this to try and profit from it, or are you looking to avoid pitfalls and bear traps this way? Is this minimizing risk?
Both. So in terms of I mean, we haven't spoken about how I invest, but in terms of index investing, I'm following themes in terms of price earnings types themes around the world and yields, and looking at markets and seeing how that works globally and how one sector catches fire versus another doesn't. When it comes to individual funds, what I might smell is that a fund is heavily laden on drink stocks, and you think, well, actually that's a fund to avoid. Or equally, if that gets overplayed as an issue, then you think, well, actually might be a reason to go into that fund. So it does both. But the more you know, the more you're in a better position to respond.
One thing came to mind, going back to your mentoring, do you talk to your mentors about their own sort of finances and their private financial journey, or are you very much talking to them as a sort of business mentor?
So very much business mentor, but it always comes up. So once they start to generate cash, a big part is, well, what do you do with that cash? And given that they are very early in the stage in their life often, then that means that this is the time for them to get and invest. So I encourage them to do so, but I very much steer away from giving any advice on how to do it. So I will say, look, you really need to start looking at savings. I often direct people towards Dave Ramsey's 7 Steps. I just think it's a good introduction to the world of investing and how it all works, or personal finance, and then almost leave it for the YouTuber to do their work thereafter, rather than try and give any personal direction on how to invest.
Interesting, thanks. Yeah.
And in terms of our listeners, if they, I mean, most of the people that we're talking to, I imagine, are passive index investors, and for some of them, surely this will have sparked a little bit of interest. And well, what would you advise is the next step if somebody's interested in, well, where do I take it beyond the indexing, or how do I improve my knowledge? Where would you direct them? Where do they go next?
It's a tough one, because I can't think of an obvious source of information that says, if you want to step outside of indexing, just read this and then you'll know how to get into the world of active investing.
Yeah, it's more complex, isn't it?
That world is so vast. And if you said, well, just go learn about this sector, you'll just learn about one small sector. So I do think that if, like, you've got to tread carefully before you move into the world of active investing. I think the starting point or the journey I would suggest is start off global and then start to think about, instead of it being one world, the world consists of, there's the US, there's Europe, there's Japan, there's emerging markets. So could you segment the world in those areas and look at the relative performances of each of those indices and understand what's behind them? So I can tell you, you've got a lot of concentration risk in the US at the moment. There was a point at which emerging markets might have been a good way of avoiding that. But if you look at emerging markets today, they've got massive concentration risk in the form of two South Korean companies and TSMC, as they've got as much concentration risk. So you also have to understand the value of the market, why it's where it is. But I think there's a relative play there where you can play across indices without having to have an awful lot of knowledge compared to learning about the world of individual stocks.
Right.
Really interesting.
Okay, well, I think we're coming to the end of our podcast now, so I think that's really useful, Richard, and thanks very much. And we look forward to seeing you at the next meetup. I think we're all sharing a lodge together in May, aren't we?
Very much so.
We were plotting, Mike, before you joined us. We were plotting that next month we're hoping to meet up at the Carnarvon gig and go and put our boots on some hills in North Wales.
Oh, even better, and put our swimming trunks on as well.
I also have a big son who's lives in Nottingham, so I think Chesterfield and Nottingham meetups are within striking distance. I might drag him along and get him to go to an early stage because he could do with the education.
Excellent. That sounds good.
We always like bringing some youngsters along. We do get a few, and it helps to lower the average age a bit.
And significantly, I think, if you get a 20-year-old in.
Yeah.
Right, I think we're all done. It's my bit now. Thanks for listening, everyone. If you enjoy the podcast, please nudge the algorithm by subscribing and giving this episode a like. Our next episode is planned as a Q&A special, answering questions posed by members of our Facebook group. You can find the group and our wiki resource with dozens of articles on fire topics on our website, thefireplace.info. That's all today. Thank you, Richard. Thank you, Mike. Bye-bye.
Bye-bye. Thanks, everyone.